Good afternoon, everybody. Happy Tuesday. You know what that means. The markets, we're open. We're trading. We've got crypto. We've got stocks. Spencer, what are you watching today?
Yes, Tuesday does mean the markets are open. Did you know that?
Yeah,
If you
just
didn't,
like
now
Monday.
you know. That
Just
is
like,
that is what Tuesday means.
yep.
It means the
One day
markets are
away.
open.
One day away from Hump Day. Although Spencer, we will not be live on the midday show tomorrow or Thursday. Why is that?
That is correct. Most of Benzinga programming is taking the next 2 days off because we've got our second to last small cap conference of the year tomorrow and Thursday. Real quick before we move on with the rest of the show, what we have planned here. Let me bring up. I'm going to bring up our website right now. I'm going to share my screen. Let me just show you all the calendar for the rest of the year in terms of Benzinga events. I just lost my screen, so 1 second. Because we only have 3 events left for the rest of the year. I guess technically 4. So here, I'm going to share my screen. BenzingaEvents.com is where I'm going. There. Okay. So you guys see that? Yes. Okay. So we've got our small cap conference tomorrow and Thursday, right? 9:15 to 3:30, give or take, both days. Our FinTech Awards, November 9th. By the way, if you have never attended or voted for the Benzinga FinTech Awards, let's talk about that for a second. Voting actually ends, I think, like the end of this week. Oh, yeah. See, it says right there, October 29th. Voting ends on Friday. No, you guys can't see that screen. Hold on 1 second. I'm going to bring it up for you. You can vote for. Aaron says move my mic down. It's covering my face. Sorry. Here. Benzinga FinTech Awards.com. Okay. You can vote for every category that we've got. Okay. This is a democratized award show. We've got categories for fintech platforms. We've got categories for personalities, best new products. Here's all the categories right down there. You can vote. Best influencer. These are all the judges we've got to from the crowd vote. We then vote on the winners for the judges, with the judges, and yeah, this is going to be a virtual event, but there is going to be an in-person element to it. If you're in New York and you want to come hang out with us for the after party,
I do.
you are not invited, AB, but some people will be.
Oh.
I believe it's going to be November 11th is the after party. So there's a ticket right there on the screen. So we've got the FinTech, we've got the Small Cap Conference tomorrow and Thursday. We've got the FinTech Awards November 9th. And our last event of the year is, we have a boot camp. I'm sorry. We have a boot camp on the 20th. And then we have one more Small Cap Conference on December 8th and 9th. And then that's it for the rest of 2020. So we are coming to the end here of the event slate for this year. So we got a lot going on. So anyway, that's why we will be off tomorrow. And Thursday is for our second to last small cap conference of the year. Hey, speaking of that, actually, on Thursday, I'll be emceeing the track tomorrow, but Thursday is going to be the crazy one because Thursday we've got Funware coming on the show. That's going to be crazy.
Ticker PHUN. That's one that everyone's been watching. I see a couple people in the chat talking about Sundial as well, ticker SNDL. We will check in on Sundial's chart as well. But before we do that, let's take a look in the crypto world, see what's going on.
Yeah.
This handy little heat map is found on benzinga.com/cryptocurrency. As you can see, it's kind of a mixed bag for cryptos today. We've got Bitcoin down about 2%, Ethereum down about 1%. Solana down more than 5%. So Solana's getting kind of hit. Cardano's pretty flat, down only 0.36%. And then the ones that are in the green, we've got Dogecoin pretty flat, up 0.06%. So very flat there. VeChain is up 1.7%. Polkadot pretty flat, up 0.02%. Ripple up 0.5%. ICP No, not in Insane Clown Posse. That's Internet Computer is up more than 6%. So ICP having a good day, kind of outpacing the rest of the crypto market. Anything in particular that you're watching when it comes to crypto,
Not
Spencer?
so much with regards to the heat map, but did you see the thing about Tom Brady, Aaron?
Yeah, that the guy who gave him back his 600th football is his 600th touchdown pass. The
Yeah.
football, he's getting a Bitcoin through. Well, here's
That's
the thing.
that's not a good deal, right?
Um,
Like whoever that guy is getting ripped off. That football is worth more than a Bitcoin.
Well, okay, so there's two sides to it. Yes, you could have kept that football and tried to sell it on the market for, $500,000 or however much some big Patriots or Tom Brady fan would have paid for that, or maybe a Bucks fan, but I don't know. It seems like that'd be up someone's alley that's up in Boston that just has a bunch of money. That's like, oh, I want Tom Brady's 600th touchdown ball.
Yeah.
But the other side to it is maybe he's a big Brady fan and wanted Brady to have the ball, and now he's getting not only the Bitcoin, which is worth about $60,000, but he's getting tickets from the Bucks, gear, etc. But yeah, Tom Brady is getting a lot of love for that, but he's not personally putting up the money for that Bitcoin. It's through FTX. It's a promotion. They know they're getting a lot of press coverage from it, so it's well worth the $60,000.
Yeah.
I mean, they could have sent him 5 Bitcoin and it probably would have been still worth their while with how much free media attention they're getting for that. But yeah, he was on the Peyton Manning and Eli Manning broadcast last night on ESPN2 talking about it. So yeah, Brady's making the media rounds, loving that good press he's getting from the Bitcoin. So whoever his idea that was at FTX, good on you.
All right, hey, we should probably tell people what's coming up on today's show. So coming up right now, we've got Lior Tal, who's the CEO of Syngen, ticker CYN. This is a company that IPO'd last week. We're going to talk about that coming up here next. We're also going to talk to the CEO of Recruiter.com, Evan Sohn, in around 15-20 minutes or so. We'll be joined by Tim Quast from Market Structure Edge at 1 o'clock. And that'll take us to 1:30, and then we'll see how we feel. How about that, AB? Does that sound good to you?
Maybe once Tim leaves, and it's just you and I, maybe that's when we get into our YOLO trade segment.
Ooh, I haven't done a YOLO trade in like 4 days. So
you're due.
I'm due. And you haven't done one in like 3 days. So you're like doubly due.
Yeah, exactly. All right. Well, without further ado, let's go ahead and bring Lior on the show. Exciting company, some autonomous driving, something that everyone's talking about right now, whether it's Tesla. But yeah, let's go ahead and bring Lior on and have a chat. Lior Tal, the CEO of Syngen. Lior, how are you doing today?
Hey guys, how are you?
I'm good. Thank you for taking time out of your busy Tuesday to join us. So before we get started, for some of our audience that may not be familiar with Syngen, do you mind just giving us the quick, elevator pitch of the company, what y'all do?
Yeah, of course. So everyone hears about autonomous driving, autopilot, self-driving, open roads. You see, even news about the Mars Curiosity rover. But really, where autonomous driving is going to make landfall and real significant impact is in the industrial world. And these are warehouses and manufacturing sites, mines, airports. And at Syngen, what we've been building for the last 5 years is the driving software that can replace the human operators on these vehicles. So it's an exciting time for us to move from that R&D phase into start commercializing it, and through that also moving to the public market.
So where are you on the commercialization front?
So, like I said, the last 5 years were really intense R&D. We've been building it in the streets in California and testing it in a container port in Southeast Asia and with a large retailer in Canada. And all of that is really to stress test the system in much more complicated conditions to where we want to deploy it, and that's inside warehouses doing material handling. We have a recently announced collaboration with the Columbia Vehicle Group, which is one of the largest industrial vehicle manufacturers here in the US. And together, we're now starting to take the first steps to put their vehicles with our software in the hands of a few select customers. Throughout the next 18-24 months, we're going to do more and more of these as we start ramping up that operation, more vehicles, more uses towards really scaled up operation in 24.
Can you speak a little bit about the cost here. Like if I'm an airport or some industrial manufacturer, I guess I have a choice. I either pay people, or when the time comes for a company like yours, I can pay you. Can you speak a little bit to the cost breakdown here and how you make it scalable and affordable?
Yes, of course, it's a good question. So let's start with maybe the problems that autonomous driving solve, right? So you mentioned cost of labor. You look at these machines that we're taking on first. These are roughly $30,000 to $40,000 machines that drive heavy loads inside large facilities. They're usually operated by 2 shifts. So the annual cost of the drivers for these vehicles are in the order of $120,000. The big problem, and I think that's one of the headlines that have recently been in the news, is you can't get enough people to do these jobs, right? There's a huge labor shortage, which means you can have a facility that would like to open a 3rd shift or operate on weekends. They just can't do it. Now you take the cost of labor, you take the ability to increase productivity by adding more operating time. Now you have to add 2 more things. The first one is safety, because people are just they don't like these jobs, right? They're repetitive, they're physical. People get bored, they get distracted, they get into accidents. So now you add the safety to that. And of course, the software drives these vehicles more effectively. So it makes for a sustainability impact as well on these companies. So now you bucket all of these and you say, the minimum value is the cost of labor. You can add the increased productivity, you add the savings from safety, and you add the saving from sustainability. So if you're an operator of, it can be a mine, it can be an airport, it can be a warehouse. We are looking at licensing our system at the order of about $60,000 to $120,000 per vehicle per year. We work on a SaaS base, so license for the software. The vehicle, like I said, is fairly negligible compared to the total cost of ownership of these solutions over years, and they can live several years. So the order is you're already saving money on the cost of operating, and everything else is added on top of that.
So it's only one type of vehicle right now, right?
So the first ones you can see in the Colombia Syngen announcement is a vehicle called the Stock Chaser. Okay. Stock Chaser is a vehicle that moves, pallets, material component parts inside large warehouses. You can tug with it, so you can connect carts and tug even heavier loads. And exactly, that's the vehicle. Those are fairly simple machines, which means we can easily retrofit them together with the OEM and replace existing fleets of customers already invested in their fleets. And over time, through our collaboration with Colombia, the Colombia Vehicle Group, and other OEMs, you will see vehicles like this come off the line, ready for autonomy, which means they don't need to be retrofitted. They come out of the box ready to connect the computer and just turn on.
So
yeah, go ahead.
Lior, you mentioned the labor shortage right now that's affecting the markets, but there's another shortage, and that's in semiconductors. How has Syngen been dealing with that? Do you guys outsource the chips and stuff that you need for this autonomous driving software? And if so, who are you outsourcing those chips from?
So this is one of the biggest benefits of us focusing on the software and really abstracting our solution from the vehicle and the hardware. So our software works on a variety of different vehicle types and on a variety of different computing and sensor types, which means that we can buy off-the-shelf components, we can buy industrial PCs of different makes, we can combine different components and different chip vendors to make it work. Remember, this is not a 60 miles per hour Tesla riding on a highway that needs to develop its own hardware. This is a vehicle that runs inside a facility fairly slow, 5 miles per hour usually. So that flexibility really helps us bridge through what's happening today with the chips. And the same thing with sensors. We've been working with 7 different LiDAR companies, many different camera companies. There's a new one, there's innovation, there's opportunities to buy better components. We just swap them and turn the system back on.
Okay, so you just brought up the Tesla thing a little bit. So yes, your machines are not going on the highway 60 miles an hour, but there are other things that your machine will have to do that a self-driving Tesla will not have to do. So can you explain? I could see why in some respects developing this type of self-driving vehicle would be easier, but in other respects, it would be harder because it actually has to abide by the parameters of the job.
Yeah, so I wouldn't say easier. I think it's a different problem, right?
Okay.
It's a different problem. When you think about self-driving in general, anything you want to replace a human operator and introduce software to do that job, you need to understand what's called the ODD, the operating design domain. That's the language of the problem and the environment. What is the vehicle? What is its mission? Is it just driving, or is it also picking and dropping? How constructed is the environment? How chaotic is it? Everything around it is a factor, right? So in the industrial environment, because it is the regulation is in a completely different order than the open roads. It's mostly driven by safety standards and the ability to integrate to an overall operating system. There's just more flexibility in how to solve those problems. Like I said, we can start with off-the-shelf computing platforms today. We have multiple layers of redundancy and safety. So, for example, our software sits on top of, that Intel NVIDIA platform, whereas underneath that, there's a complete separate standalone system that detects whether the vehicle is getting too close to something and can just break it. And by being able to combine these different available components, we can solve the problem at the required level of safety at the cost that's needed. Now, over time, as components become cheaper, more commoditized, more options become available, we can take advantage of that, and we can either retrofit the vehicles or build the new ones with the new design. It's more difficult in automotive. The process of building these vehicles is longer. Testing, validation, it's very hard to replace these things.
It's interesting that we speak to you now, Lior, about this exact topic, because as I'm sure you are aware, there is a strike going on here in the US at John Deere at some of their facilities. And this sort of gets to the heart of the issue, right? Because what you're talking about is essentially replacing workers with more machines, and so this is a topical problem right now. Do you have a take on, not that you can comment specifically on what's happening at another company, but do you have a take on just from a macro level the implications of a company like yours and the impacts that it could have on the labor market?
Yeah, like you said, it's a very discussed topic, and it's in general, how innovation impacts people's jobs, how these new technologies change the needs of organizations. But I'll tell you this, and I think this is something that's maybe worth considering. By introducing these new capabilities into the tools that are available to a company and its employees, the first thing you can really impact is what people don't want to do, what people are not good at, and allow them to upskill to other roles, to other jobs that take better advantage of their capabilities as humans, solve problems, do creative work. So I think at the beginning, because there's such a big labor shortage, these technologies augment human workforces. But over time, I think similar to the entire Uber driver workforce that never existed before that product was introduced, there's going to be an evolution of people's jobs. We have people on our team that are fleet supervisors, that are sitting behind screens in air-conditioned environments. They were forklift operators before, and they learn new things, and over time they become more leveraged and they can supervise multiple vehicles. So yeah, it's a loaded question, but I think it's very important to understand that it's practically impossible to stand in the way of innovation and things that are that will that it's justified for them to be disrupted, just will be disrupted because of aggressive companies like Amazon and others that are very strategically going after robotics and automation and opening up that ability for a lower margin, a lower cost and higher margin, and full flexibility of their operation. So
Fair, I suppose. Yeah. And how far out are we before we start seeing some revenue?
Revenue will start coming very soon. I think this is one of the first stages of combining the beta stage of EAS, the Enterprise Autonomy Suite we've been working on, plus the partnership that we've announced and a few new ones that are coming, and really putting both in the hands of customers. These first customers are going to be more selective because we want to make sure that everything is tightly integrated, everything is ready before we start scaling up. So revenues are going to probably be nominal for the first several months, and then as we start getting comfortable with the traction and these partnerships are going to start maturing where the companies work effectively together, we start dialing up and start scaling.
Fair. Isn't it reasonable to say maybe next year start seeing some substantial revenue?
I wouldn't say substantial, but yes, revenues will come next year. And again, it's a function of how we see the traction with the first customer, how aggressive we'll be with dialing up more and more deployments.
Got it. All right, Lior Tal. I'm sorry, AB. Sorry, go ahead.
I got one last question. Outside of the revenue, I was just curious what milestones investors should be on the lookout for, maybe in the next year, 2 years. I know you mentioned the Colombia deal. So yeah, are there any other milestones that investors should be looking forward to?
Yeah, it's a good question. Going back, like I said, we're a software and data company. We are horizontally focused on a wide array of different industries. So for us to go to the market successfully, we like working with the best companies in that specific sector. So partnerships like Colombia to go into material handling, Symbioticware to go into mining. A few of these are going to become announced over the next few months. That combination of the vehicle manufacturer or site operator plus our software is the path to the market. So keep an eye on partnerships and ecosystem announcements. The other side of it is, like I said, these initial deployments, showing success stories, showing traction with these customers that indicate that there is a great product market fit and it solves the problems that we talked about. And of course, always recruiting, growing the team, bringing great talent, which is at the heart of our ability to do this.
Awesome. All right, Lior Tal, CEO of Syngen, ticker CYN. Thank you for joining us on the Power Hour. We look forward to having you on again. Anytime you guys have news, anything happening, we'd love to have you back on.
Thank you, guys. Have a great day.
You too.
And there you can see the chart up on the screen. So yeah, it's only been live, only been open for a couple of days. Not much to really say about it, other than we did have a interesting spike yesterday, up near $10. But yeah, not much to say about the stock because it's been trading for less than a week. But and also very topical in light of recent events at Deere. So.
Yeah, well, and also, I mean, full self-driving from Tesla just got delayed again. So, I mean, this is something that a lot of investors are looking for as far as who is going to be, a leader in this space of autonomous driving. The reason I was asking about the chips is because that's one of the bull cases that I like about NVIDIA is that NVIDIA does a bunch of different things, but NVIDIA's technology on the self-driving autonomous, I think you're going to start seeing NVIDIA chips in self-driving cars and robots and workforces. So not just, gaming chips, computer processors like we have now. So I love NVIDIA. I talk about it all the time. But Spencer, that was a good question you asked about.
Thank you.
The implication. But what I was going to bring up is that people have been kind of worried about that, calling for that forever. I mean, in the 1950s, when computers were first becoming a thing, people were talking about, computers are going to put laborers out of the workforce, all this.
Take our jobs.
And what ended up happening, the exact opposite, that computers and innovation created jobs. So I don't know. It's tough because, I mean, if we have full self-driving 18-wheelers in 15, 20 years, that's a whole bunch of people that aren't going to have jobs driving trucks. But is that innovation going to lead to more job creation? History tells us yes, but we shall see.
Yeah. I know that's not a new trope, but it is maybe more topical now than it has been at any point. Okay. Our next guest will be here momentarily here. Evan Sohn is the CEO of Recruiter.
We can only hope so.
Well, I hope so. In the meantime, AB, I did want to look at Facebook. As I pull up the chart on my screen, there it is. Let's go to intraday chart. There we go. No, actually, no. Back to the daily. Look at the size of today's red candle. When is the last time we had a day like this in Facebook? Was it that day, or was it October 4th?
What was the day after Snap's earnings?
Okay, that was, but I guess in terms of not like in terms of the gap, because there was no gap to speak of this morning, but just in terms of just the size of the intraday move downward. It's been a while, maybe like January 29th. Like, because
the headline that I saw earlier,
what the red candle shows us is it was what happened between the opening and closing bell, and Facebook opened higher relatively flat, but higher this morning. Off the pre-market high here. I'll pull up a pre-market chart. It was off the pre-market high, but it was a little bit higher, a little bit, and or it was flat. Maybe it was flat. In any case, we've gone straight down from the open. So the last time we've had a day like this, we've gone straight down from the open, and not even in the pre-market was, I think, January. What were you gonna say?
I was going to say I saw a headline across the screen earlier today on a different financial news outlet. Not going to name names because they're not as good as us, but it said that someone was saying that Facebook had a serious growth problem. So obviously for investors,
I don't know. I mean, their daily active users came in line with estimates. What Facebook has? I'll tell you what Facebook has. Among the problems, and they addressed this last night in the call. They have a young person problem,
right? And I think that's the growth problem that the headline was referring to. That they're not getting more and more young people signing up for Facebook and Instagram. And I mean, anecdotally, this doesn't mean anything. It's not quantitative. It's not numbers or anything. But I know a lot of people my age that have not only, I mean, most of my friends, people my age, haven't been using Facebook, the actual Facebook website or app for like a couple of years now. But I know a lot of people my age that are now deleting Instagram too, that they're like, yeah, this is just a waste of time. I don't need it, whatever. So I think if that ends up, actually being shown in any numbers that young people are using Instagram less, I think that becomes a huge growth problem for Facebook. Yeah. I think on the value side, we will see buyers coming in eventually because they do have some really strong revenue makers in Facebook. So you can make the argument that at a value standpoint, that if the stock continues to sell off, that it becomes undervalued. But right now, I think the sell-off is all related to what you mentioned as far as
When I said they had a young person problem, I was not referring to Solar Up's comment in the chat. I was referring to Crypto Morning Show's comment in the chat. Right? They have a demographics issue, and they admit it. They admit this, right? They've lost market share to TikTok, and people have migrated away, even to Snapchat, or even just to like group messages, right?
Yeah. Well, that's it. Last thing before we bring before we bring Evan from Recruiter on, but I don't think Facebook cared that young people were leaving the actual Facebook platform because Instagram was the most used social media app for young people anyway. So they're like, okay, fine, they're going to leave Facebook, but they're not really leaving us because they're going to Instagram. But now I don't think you're seeing that same growth on Instagram. So that becomes a big problem, especially as you mentioned, if more young people are using Snapchat, more young people are using TikTok, then they're losing that very coveted demographic of like 16 to 24-year-olds. Rampreet, we're talking about why Facebook is falling.
I know Rampreet's question was, why is it falling to like from the open as opposed? I mean, it kind of did fall a lot in the pre-market. As I'll pull up overnight chart. It was higher last night because compared to Snapchat, the report wasn't bad. It really wasn't. The numbers were okay, but I think as people digest the conference call, as we see reactions from the street analysts, it better than Snapchat isn't necessarily good enough. So, and there's many headwinds against Facebook. There's negative press on it every day. So
I'll say I've said it before. I'll say it again. I like the Oculus side of Facebook's company. I wish if in a world, we did have an antitrust case against Facebook that actually gets through the courts and they broke the company up, I would be buying Oculus stock. But obviously, I cannot buy Oculus stock. I would have to buy Facebook. So I'm taking on all those other headwinds as well. All right, Spencer, enough of us blabbering. Let's go ahead and.
What did you say? Is that a word? Wait, what was that? Blabberating?
Blabbering. Did I say blabberating?
Blabberating?
I don't know. Rohan, we'll go back and clip it. I don't think I said blabberating.
All right, let's get Evan Sohn from Recruiter.com on this show. Someone whoever's in charge of this show, can we do that here? Evan Sohn from Recruiter.com. Thanks for joining us today. How are we doing?
Hey, thanks so much for having me on your show. We're doing great, even though it's raining outside here in New York.
I heard you guys are about to get some flooding. is what I heard.
Yeah, my it's the only time your house line rings is when the city reports that there's flooding going on. So we just kept
That's
singing
true.
on
All
the
right.
television last night. Flood, flood, flood. We're like, all right, there we go again.
Stay
Are you on
elevated
Facebook,
and
Evan?
stay dry.
Of course, I'm on Facebook. I'm over 50.
Okay.
Now, ask me if my kids are on Facebook. They're like, they're not on Facebook, right?
They don't even know what Facebook is. All right, Evan. Well, I guess I want to ask you about the company, but before we get to that, I want to start with just the overall labor market here. You have a good pulse on that, right? That's your business. That's what your company does. Where exactly is the labor shortage now? So in terms of like what sectors of the economy, where is it the worst?
Well, go to any local restaurant and you're going to say that's probably the worst, right?
Right.
I would say restaurant hospitality. I think the hourly, let's call it less skilled labor is probably the toughest hit, the toughest, the hardest to come back. So I would say that, there's like 9 million people still unemployed. There are 10 million open roles. It's really the hourly workers that are really still the biggest gap still in the market today. By the way, that's recruiter.com.
Oh, I'm sorry.
We'll fix that.
Producer, fix that right now. Gosh,
I don't know who did that.
I don't know.
But Evan, what do you make of the people that are saying it's not as much of a labor shortage, but a shortage of jobs that are paying a fair, willing wage that people would be willing to come out of their house and work for that wage?
Yeah. So the answer is, I grew up in an either or world, Sony or Betamax, HBO or Showtime, Yankees or Mets, if you will. There you go. That's very nice. And we're in an and both world today. So there are many reasons why people aren't coming back to work. It's everything from I'm waiting. The salaries have been going up month over month. So let me wait till the salaries get better. By the way, I heard a really interesting one last week, which is, for many Americans, grandma is their, a grandparent is the child care, right? Both parents work, and who watches the children? Grandparents watch the children. But if the grandparents have succumbed to COVID and they passed away over the year, they've lost their child care. So when we talk about child care, it's not just the formal, hey, I pay someone to watch my children child care, but hey, if a grandparent was doing it and now they're not coming out, and by the way, forget that they've succumbed to COVID. Maybe they're too scared to come out. The children aren't vaccinated. So the people that the grandparents are watching are unvaccinated. They're not going to want to subject themselves or be at risk for dying or getting sick. So all of a sudden, there's a whole population of people who just don't have childcare anymore. That's contributing to people not coming back into the workforce. I totally think it's the hourly wage, but I also think that there's a huge backfill going on right now. Huge backfill.
So you mentioned, the vaccine there and talking about the grandparents. So what about, is that a factor as well, that maybe employers are mandating the vaccine and some people that are out of jobs don't want to get vaccinated, so they don't want to go work at a place where they would have to get it?
Look, the answer is yes. Look, whenever you have a talent shortage, you remove as many barriers as possible in order to increase that talent shortage. By the way, just to sort of prove the point, pre-pandemic, we were at the tightest job market really in a very, very long time. It was the highest employment of ex-cons in history, right? So why? Because if I need a Java developer, I don't care what they have on their record, right? I need a Java developer to get something done. Again, I'm exaggerating to prove a point, but I think there's lots of elements there. So yes, if I've optimized my company, if I'm prioritizing being in the office, and therefore I'm prioritizing that people want to be vaccinated to provide a safe and secure environment, then I really want to make sure that I'm only going to allow people coming into the office that are vaccinated. By the way, we're seeing it on the other side. You're seeing a company that is 100% virtual now, like we're letting people remote work from anywhere, but that's going to come at the expense of, we don't want to take entry-level people anymore that've never worked before because our training protocols are different. So, we are in a very, very a very strange job market where everything is happening. And I think companies are deciding what's most important for them in order to get people to come back to work.
Yeah. That's interesting. Go ahead, Spencer.
I'm curious, because I remember hearing a lot about this back in like May and June. And the warning was, it's going to be a really tough summer for the hospitality industry, but hopefully once we get through that, things will get better. Well, we're through that now, and it's not really getting better. So what are the signs that you will see from your point of view that things will turn around? Is it more, is it fewer listings? What will be the signals that you'll see?
So, the greatest litmus test really is this net new jobs being added every month, right? So, we all saw 194,000 jobs being added last month. We called it, actually. We knew that there was a higher number of backfill roles. And keep in mind, guys, that there were millions of people hired last month. Millions, right? 4.3 million people left their jobs in August. They didn't just they didn't leave to go home, right? They left to go find something else or whatever. So net new was 194,000 jobs. That means that we're having to backfill lots and lots and lots of roles. And the answer is that until we start seeing that net new number really crawling up higher and higher and higher, that's when we're going to start seeing an impact to the to the people on the sidelines. Like we would have wanted, we would have wanted to see the million. Where's the million? How do we hire 1 million new people in a month, or 500,000 or 600,000? Until that's happening, and the drag against that really is this backfill. That really is the drag.
So, Evan, I got a kind of interesting question. So you mentioned the jobs report, 194,000. I think, was that the one that missed the estimates by a lot?
Yeah, that was last month.
So there was a couple bad ones, but yes.
So but there was one where the estimates were just like way off. So is there a way for investors, like our viewers right now, to kind of see some of this data from recruiter.com to try to get a gauge of how many people are looking for jobs or getting hired, and saying, oh, hey, I think this month we're going to crush estimates, or I think this month we're going to miss estimates? Like, do you sell any of that alternative data?
We don't yet. We think about it all the time. We use the data. That really helps us steer our own ship, if you will. Like, we know where the hockey puck is going, right? We see the hockey puck and where it's headed to. Now, let's also keep in mind, when does one use a recruiter, right? So let's actually look at that, right? Because at the end of the day here, there are two ways to hire. You either do it yourself or you have someone else do it for you. And we play in that have someone else do it for you hybrid. We're sort of reinventing this industry, and we'll talk about that in a few minutes. But doing it yourself means putting a job on ZipRecruiter, Indeed, and LinkedIn, right? Or if you hire someone to do it for you, that's what they're doing, and they're doing the whole process for you. So I think that when you use a recruiter, it's usually been in that $80,000 salary and above, right? So why would you hire someone to do it? And forget the fact that you're paying someone, notice our model's not success-based, except in certain areas. So instead of no one's going to use a headhunter paying 20% of a salary to find a $40,000, year person. However, when you need lots and lots and lots of $40,000 people, that's when you'll start using teams of talent acquisition professionals and tools to make that happen. And what we really saw over the last 3 months is our average recruiters, they were working on about, I think, 16% more of those roles, of the $40,000 to $80,000 salaried roles. So that's really interesting when you think about a company that used to just, put the fishing line out and catch people left and right, saying, oh crap, I need to be more proactive in bringing these people in. And I think the message to the audience is, I think we're entering this, what I call the job hopper economy. So the things that my dad told me not to do, which is you got to stay at that first job at least 2 years, that's going to change very quickly. And we're going to see a lot of movement around in the job market. So to your audience, which are really investors, I would look at the companies that are going to benefit from this churn, this movement in terms of employment, where people are going to be leaving jobs every 2 to 3 years. And again, I'm generalizing, but there's going to be a lot more people that are moving jobs. There was a survey done not too long ago, and 60% of millennials had no problem leaving their job within a year, within the first year of that job. Now that really just is telling us that this job hopper economy is not an episodic thing. It's not just because of COVID. These are things that were happening anyway, and now we've just moved that process faster because of COVID and the pandemic.
So who are the biggest competitors, Evan? I mean, is it Glassdoor, Indeed?
To us?
Yeah.
Yeah, so we really compete, ironically, first of all, the recruiting industry and staffing industry is a $120 billion industry, completely fragmented, lots and lots of players. So you have everything from Heidrick and Struggles and Korn Ferry at the top end of the market, at the executive recruiting side. You have LinkedIn, ZipRecruiter, and Indeed, and Monster, and Glassdoor, and all the others in that do-it-yourself sort of model, the online job board. You have Kelly Services and Manpower in the staffing space. And then you have thousands and thousands and thousands of small and independent recruiters. So we really compete. That's really the place that we're playing. We compete with the existing in-house hiring place. That's really what we do.
Interesting question from NCal in our chat. I guess your numbers, your data, would it be where does it fall on the spectrum of like the ADP number versus like the non-farm payroll number? ADP is of course measuring, from ADP's client base, and non-farm payroll is a survey from the government. Where on that spectrum do your numbers fall? Like what exactly are you measuring?
We generally measure sentiment.
Okay.
We look for like, hey, are recruiters feeling really good about the market? The best way to look at that really is if you asked taxi drivers in New York, hey, how's business? And they'll say it's really quiet. That's going to be a leading indicator that people aren't going out.
Yeah.
So we started tracking really at the beginning of the pandemic, the recruiter sentiment. How do they feel about the market? What industries are hot? What are candidates saying? What are their priorities? And we've been able to really have a very good leading indicator prediction about what the market's looking like looking at the last 30 days and the next 90 days based on the recruiter sentiment.
I want to ask you about your company for a second, your business, and I'll bring up this slide in a second here. But your recruiter on demand segment, as far as I can tell, was a segment that didn't exist a couple of years ago.
Yeah.
And I want to bring up the chart here, and I want to show just I'm referring to the orange bar, everyone.
Yeah.
That's what I'm talking about here. The orange bar basically grew from nothing to kind of like half your business. So tell us what this business is.
Yeah, sure. So, I love platforms. I'm actually not a recruiter. My background really is operations and platforms and reinventing industries. And what I really saw was sort of how do we look at this industry, which was either do it yourself or hire someone to do it, and change that model. And what we really started to do with Recruiter on Demand was provide a recruiter, let's call it a fractional recruiter, an on-demand recruiter like a freelance, to companies of all sizes. So we have companies that are using 30 of our on-demand recruiters. We have companies that are using one, and they pay like Upwork or Fiverr. We are a freelance platform for recruiting. So this could be everything from a senior level oncology recruiter finding top level scientists to a recruiter that is sourcing factory workers for a manufacturer, and really everything in between. And we really started that business about a little over about a year ago, actually. So, and it's just been incredible to watch that growth.
Yeah, it's kind of incredible to see. I mean, it's not like you didn't have a business before that. You did, but you've basically just doubled your revenue from one segment.
So the answer is, I became CEO in June of 2020, really at the height of the pandemic, knowing that when the world was over, this is my favorite slide, by the way, knowing that when the world, when the world starts to open up, thanks, the job market is going to be so crazy that every company is going to need two things. They're going to need more candidates in the pipeline at the top of the funnel, and then more people to manage the candidates through the funnel. And so it's top of the funnel is our software, and bottom of the funnel are recruiters. Because at the end of the day, guys, no one is hired. No one. I don't care whether you're the dishwasher or the CEO. You're not being hired to work at a company without speaking to somebody. And if you have to go through more and more candidates, then you need more talent acquisition professionals to do it. And we work with high-tech startup companies in Silicon Valley. They just raised money. They need to hire 40 people in the next 4 months. They don't want to spend $400,000 in, with headhunter fees, right? They actually want talented recruiters like Uber, so tongue in cheek, we're Uber for recruiting, or more like Fiverr and Upwork for talent acquisition. And that's really what we're delivering on an on-demand basis, as well as having really awesome AI software to drive the pipelines of candidates. So we really combine the two together.
Right.
So Evan,
AB, I keep interrupting you. Go ahead, man.
Sorry. NCal in the chat just has a good question. We like to take some questions out of our chat. He's asking if you guys measure sentiment. You mentioned with the taxi drivers would be a leading indicator of who's going out and whatnot. Is there any sentiment right now that you guys are finding, anything standing out?
Yeah, so this isn't a commercial for it, but we come out with the October index, comes out next Thursday, I think it's November 4th. So we'll come out the October one, November 4th. What we saw last month was recruiter sentiment tick down just a little bit because it was getting really hard to actually place candidates. So you started to see candidate sentiment was finally moving up because the Great Resignation is starting, or that was our theme last month, that the Great Resignation is upon us. The sentiment ticked down just a little bit on the recruiters because it's getting harder to actually fill those roles because candidates are now looking in lots of different places.
Yeah,
Got it.
Yeah, that definitely makes sense. This is Evan. We definitely have to have you back here in a couple of months because I can't remember everyone being as interested in the labor market as they are right now.
And yet our stock doesn't reflect it, right?
Hey man, that's the way it goes sometimes, right?
The answer is that I call ours the most undervalued stock on NASDAQ. But the reality is that we're a startup company on NASDAQ. The URL has been around for a while, but we really got started in March of 2019 as a company. In terms of what we're doing today, and things really started to pick up then. And we went on NASDAQ June 30, so we're really about 4 months old on NASDAQ. And we're going to grow up on NASDAQ. And I think as the world starts to get better and the job market starts to grow, we hope that our growth as a company on NASDAQ, a public company, really follows suit.
Awesome. Evan Sohn, the CEO of Recruiter.com, ticker RCRT. You just had the chart up on the screen. Evan, we'll definitely have to get you back and see how the market develops because, again, it's top of mind between this and supply chains. It's top of mind for most people right now, more than ever. So it's a fascinating time. Thanks for coming on today. We appreciate it.
Thanks so much for having me. And by the way, I talk about the supply chain of talent the same way we talk about the supply chain of chips. We have a real
now you're just showing off.
Now I'm just playing into you.
You can't combine the two. That's definitely got to be against the rules. All right. Thanks a lot, Evan.
Thanks so much, everybody.
Yeah, he can't do that, can he? Can he
I think he can.
Supply chain and talent? Supply chain and talent? Dude, that's triggering.
I think they go hand in hand.
Some economics professor right now at some university is triggered. So I don't know where he or she is, but
or impressed. You never know with those economics professors.
Or impressed, I suppose. All right. Hey, it's 12:54. We're gonna have Tim Quast on in like 5 or so minutes. I got a question from the Peanut Gallery while we had Evan on just now. It is actually from Luke Jacoby. And he asked me to ask you, Aaron, is DWAC a value stock?
Is DWAC a value stock? Well, yes. Here's the thing with value stocks, Spencer, is that typically a value stock is one that is currently making money, that has a strong balance sheet. This company, DWAC, which of course is the SPAC, Digital World Acquisition Corp, that is taking Trump's new social media platform public, I would not consider it a value stock because the company, Truth Media, does not yet exist, nor is it making money. So it would be hard to read the financial balance sheets of Truth Media. However, if you want to make the argument that you're buying this stock and the values, I don't know. I mean, I guess you can make the argument, but no, I don't see it as a value stock.
Real fast, Ranpreet Bhatia asked, are there any big name permanent clients of Recruiter.com? So SAP is a partner. They work with WeWork. Who else do they work with? Those are kind of two of the bigger names that I saw in their investor deck. But yes, so sorry, I just want to answer that question. Okay, so DWAC not a value stock. Can confirm.
No, I'm declaring it not a value stock. I don't even know if you could say it's a. I don't even know if you could say it's a growth stock. It's just a stock. It's not even a company. It's literally just a stock that people are trading. But it doesn't need, if it's got a name and it's got a chart, then you can trade it. So I don't know. I mean, it's like AMC, when AMC went crazy at its peak, the market cap for AMC was 17 times higher than it was pre-COVID, before this disease came in and completely ravished AMC's business. So I think we've seen for a while now a complete disconnect between stock share price and actual value of the company. I saw a stat yesterday on that same note that once Tesla's market cap reached $1 trillion, so the entire market cap of the S&P energy sector is 1.2 trillion, and Tesla's 1 trillion.
I know. And
so does that make sense that the market cap for the whole energy sector of the S&P is a tiny bit greater. It might be even smaller than Tesla now that Tesla was up earlier today. I don't know what it's doing now.
Here's another one like that. I don't know why the AMC up. Here's another one. I'll get Tesla up. Tesla's market cap has increased in the last week by a Ford. Like the Ford Motor Company.
Yeah, I think I saw a stat on Twitter, so I don't know.
Actually, it may have been Ford plus GM.
I don't know if it's verified or anything because I just saw it on Twitter. But Tesla's market cap equals $2 million for each car they've ever sold.
Yeah, man. You know what? I questioned Tesla like 4 years ago, and I've given up. There is no point in questioning why Tesla is trading higher.
Yeah.
There's no point. It is a fruitless exercise. It's irrelevant.
Speaking of value stocks, I bought what I would consider a value stock yesterday, and it was one that was pitched to us on this show. Do you know what that is?
Was it from Chris?
No.
It was pitched to us on this show. What day was it?
Yesterday, Monday.
Yesterday?
October 25th. Yep.
Oh gosh, it was so long ago. No.
Ticker BX.
Oh, you went and followed Ross Gerber into Blackstone?
Yeah.
You bought it now at all-time highs? Let's go to a monthly chart. Look at this. Look at this monthly chart.
I don't care. All-time highs. Okay, so what if I didn't buy Apple in 2008 because it was at 2008. Hey. Bad example. Bad year.
Was it
but what if I didn't? What if I didn't buy Amazon? Yeah, what if I didn't buy Amazon in 2015 because it was at all-time highs? I've mentioned it before. There are studies that show that buying at all-time highs isn't necessarily a bad thing.
True.
That a lot of times
it's true. All-time highs tend to get more all-time highs. There's data to back that up. That's correct. So I was just giving you a hard time. But okay, Blackstone. Ross Gerber pitched this on our show. It's a big holding in his ETF. You went and you said, yes, me too. I'm in.
I was like, Ross, okay, love him or hate him, Ross Gerber. He has more experience buying and trading stocks than I do, and I liked his pitch. That's all I can say. I was like, oh yeah.
What is this for you? Is this a trade? Is this a buy and hold? Is this in your Roth IRA? If you even
I don't know.
One?
I mean, I bought like 4 shares of it, so I have like $600 worth or something. But it's like I'm not. Okay. Well, I'm not gonna sell. I don't know. I'm probably just gonna hold it for a while. But it's not like, oh, if I hold this, it's gonna make me it's gonna make me filthy rich one day. I don't know. I just like I don't know. It's in my portfolio now.
Okay. Hex 214 Pony just asked me to compare Bitcoin and Tesla. So here, let's do it. This is fun, actually. I've never done this before, actually. Yeah, let's go out. So this is year to date.
You could see a tiny bit of correlation, I guess, except for back in February, March when Bitcoin was going up.
Tesla owns Bitcoin on their balance sheet, so yeah. I mean, to some, yes, there is some correlation. Less than 1. But there is some. Yeah, it's not perfect, but that's an interesting chart, Hex Pony. Thanks for bringing that up. I'm looking at it right now. Yeah. So wait, let's go to the last couple of months. I just want to see here. Let's just zoom in. Wow. See, this is you can just mess with time frames and then change your narrative, right? If I want to change the narrative, say, oh, Tesla's destroying Bitcoin, you could do that. You just zoom in, right? But zoom way out, obviously it's not. But anyway, interesting chart. I've never looked at that before.
Igor in the chat saying Facebook just is down more than 5% now. Let's check in on that. Wow, down 5.2%, it looks like. I don't know. I mean, I don't know where, technically speaking, where the next support level would be, where we'll see buyers come in. But
wait, I have a dumb question. I should know this. I bet you Tim knows this. This is a stupid question, so forgive me. The volatility halt. The first band is 7%.
But it's in a certain time frame.
Yeah, well, that was my question. Is what's the time frame?
I think it has to be like 7% in.
I
half an
definitely used to
hour?
know this. I definitely knew
Half
this
an
last
hour?
year when everything got crazy and everything hit the fan and was halting every day. I'm sure. Can we ask Tim? I bet you Tim knows this.
All
Can we
right.
bring Tim on? Tim,
Tim, do you know the answer?
Hey guys. So it depends on what tier the stocks are in. There
Okay.
are 3 tiers to which the LOLDs apply, limit up, limit down. And it's 10% is the first one.
Oh, 10%.
It's
Sorry.
10%, and then I forget. I think it's 20%. So it's 10%. If price moves outside of, it's a calculated normal price, average price within 5 minutes. And so then it's paused for 15 minutes, then trading resumes. And if it's halted again, then I can't remember. Here's it. I begin to forget too. How long the pause is. It might be 15 minutes again. And then if it's halted a third time, which I think is down 35%, then it's closed for the day and won't resume till the next day. And we had, believe it or not, we had thousands of those occur in March 2020.
Yeah.
Well, I think the 7%. I think the
go ahead.
7% comes in play with the overall market, because
Yes,
that
it
was
does.
happening
Right.
a couple mornings in that March 2020 was the overall market would be down 7% at open, and the market would like open at 9:30 and then resume trading again at 9:45.
Exactly, right. Exactly. That's the total market halt is a 7% move. Yeah, good job,
Okay.
Andy.
I was half.
Right.
I'll get half credit for that one.
Yeah, I agree.
Tim,
Expensive.
what are you watching here today? What's on your radar?
Well, we've been telling folks who use Market Structure Edge. So marketstructureedge.com, where it's all about supply and demand, market structure, which is the behavior of money behind price and volume. So we've been telling Edge users to cut their exposure to the market. And notice what the market did today, right? So we started way up, and then actually the NASDAQ turned negative. And you can see this developing in the data. So the short answer to your question, Spencer, is we're watching opportunities to take money out of the market. That's really it. I sold Moderna yesterday. I sold Shopify, Asana. I'm down to, I have one position left, Zoom Info. And I would have sold it today. I'm too busy. I can't keep up on things. So otherwise I would have left. I actually had a limit order in at 70.21, and I canceled it because I had some stuff to do, and I should have.
Wait a minute, that's the whole point.
Yeah.
The point is you shouldn't have to.
Yeah.
Look at it.
It was a poor decision. I should have just left.
It's okay. I've definitely jumped myself in the queue more than once.
Right.
I've definitely had an order out there and said, "Oh, never mind. I want to do it now."
Right. So here's the bigger picture, and if you wait till the market goes down to leave, then you've defeated the whole point of trading. And so you want to be leaving when sentiment reaches certain levels. To me, this is all about short-term levels. But
can we see the market, the Edge platform?
Yeah, absolutely.
Yeah.
So folks, if you want to do this along with me, if you want to, there we go. If you want to follow along, go to marketstructureedge.com. If you're not if you're a user, just follow me, and you guys will know. If you aren't, you can sign up for a 14-day trial free. Just put your name and email address in, just to do this, just so that you can see this. So, and it's a web app, so it's very, very easy to use. It's fast and simple. So here's what I'm talking about. Broad market sentiment is the waxing and waning of supply and demand in the S&P 500. Why would we use the S&P 500? And by the way, it's not SPX, which is a derivative. It is the actual 500 components that make up the market. So then we measure those behavioral changes and how those stocks collectively move on the scale from 1 to 10. And you'll notice these red and green bands here. That's where the market trades. It spends most of its time between 4.0 and 6.0. And we actually have not been below 4.0 all year. We've been to it a couple of times. So we have had no market entry point, is what I would call it, since November of 2020, which is remarkable. So generally speaking, when when the sentiment goes above 6, then the market stops rising. In fact, statistically, I ran this data over the weekend. I calculated the net returns owning the S&P 500 when sentiment is above 5.8. Any measure above 5.8 has produced 0 returns this year. Believe it or not, that's taking the net. There have been times when it's up and times when it's down, but when you net it out, the probability tells us that we don't want to own the stock market when it's above 5.8, and it's 6.5 right now.
Yeah,
So-
but like there are degrees of good and bad in the grand scheme of things. Above 5.8, but I mean, couldn't it be worse? Right?
Oh,
That's what
sure.
I'm
Oh,
saying.
yeah, absolutely. But the point is, so, what is the point? What are we trying to accomplish as traders? We want to make money. That's all we're after, right? We want to, as these are trite little sayings I use all the time, but there's a point to them. You want to take gains, not chances. If you're taking chances, time is risk. The more that your money is exposed to time, the greater the probability that something happens that you don't expect. Like you look at Corning, GLW out today. I mean, you look at the supply demand equation, that's very good. The risk is there is information in the marketplace that will cause people's behavior to change. And so the stock's down. And we could look at, anybody who's down. We'll talk about Facebook if you like. But the point then is you want to try to, I'll illustrate it this way. This is a great way to think about it. While the S&P 500 is up about, through yesterday, about 21% year to date. If you took the gains, if you separated the gains from the losses, which it's just a statistical endeavor, you can add up all the days that it rose. Well, it would be up 72%. So and then you subtract all the days that it declined, that adds up to a negative 51%. So the whole point of math is to try to reduce your exposure to the negative 51% and increase your exposure to the positive 72%, right? And that's supply demand. No chart will tell you that. There's an overarching principle to me that matters, and we're getting to, the whole point. What am I looking at? That's what I'm looking at. It all boils down to the fact that here's this line well above the red line, and the highest since back here at the beginning of April. That was the last time we had a reading this high. And what did the market do? Well, it declined ahead. I'm not saying it's going to decline, but the statistical probability that the market continues to produce this gain is very, very low. It is a number approaching 0. And here's another, I love statistics, right? This is how I think about the market. Well, the last 5 days, the only behavior up was speculative, automated, computerized trading. Investment behavior actually declined 5% the last 5 days. So when you listen to the news and they say, well, the market's up on great earnings. No, it's not. It's up on machine trading, and they were covering short positions, down about 2%. You say, well, that's positive. Well, if they
wait. This is across the entire U.S. equity market?
Yep.
Okay.
Yep. So that's very easy for us to see. We measure all kinds of data. So here we are. So the key behavior the last 5 days in the S&P 500 is fast trading. They've been buyers, and they covered short positions by 2%, went from 45% to 43.9%. But look at the sentiment trend. The trend, it's looking ahead and saying, what are the consequences of this behavior? Well, the market will go down. And look at this. This to me is absolutely fascinating.
Well, why does it matter who is buying?
Because
as long as somebody's buying, right?
Well, yes, but you have to think about the purpose and time horizon. This is why technicals have such a difficult time providing predictive indications that lead to profitable trades. I'm not knocking it, but I'm saying if there's a better way, I'm open to it, right? So if the time horizon of fast trading is a day or less, that's what it is. Fast traders who are
so you're saying more liable if trading activity, if buying is being driven by computers, it's more liable to switch on a dime.
Exactly, because they don't want to own anything. Suppose suppose there was an auction for a piece of art, and half the people in the room were bidding it up but don't want to own it, right? So what happens from that is you end up overpaying for stuff. Then they leave and you realize, son of a, I just got hosed, right? Well, that's what's happening in the stock market all the time. And look at this, and I'll leave you with, and we can move on to the next thing. But this chart here shows whether the S&P 500, the 500 components making up 83 to 85% of all market cap. With the way Tesla just moved, it may be 88% now, right? So this tells us whether the stocks close above or below the intraday midpoint. And really, you'd be surprised, almost half and half, because that's what ETFs are. ETFs are arbitrage vehicles, and they dominate the stock market. So look at this. This is why we had such a magnificent run here. We're up about 4.5% the last 2 weeks, and here's why. So for most of these days, stocks closed above the intraday midpoint, and this tells us by what percentage. But look what happened the last 2 days. It's gone. It's gone. Sentiment is peaked. The trend is down. Fast traders are setting prices, and stocks are no longer closing above their intraday midpoint. Well, what mathematically follows from that? A decline. It's not, and it may be very short. You say, well, I'm a long-term investor.
That's what I was going to say. I was like, I've seen this movie before, though.
Yeah, right. Well, but I'll go back to my point. And I want to, and I've done this with my own little trading account. I take it from 35 to 50,000. Yeah. I don't want to lose money. I want to make money. So each time that you stack 1 or 2 or 3% and you avoid the declines, you outperform the market. That is the point. And it's a disciplined approach, traders. This is different than listening to CNBC and Nvidia is a better chip maker than somebody else. Well, that's true. Yep. But it doesn't mean that Nvidia is going to continue to rise. You want to take your gains in Nvidia when the math tells you to. That's what you want to do.
Fair. Hey, there's a question from our chat. Yeah, if we can go back to here or even somewhere else, if we can set up a screener. Who asked this in the chat? From NCal. NCal, you've got some good questions today. He wants to scan for a stock with a good entry.
With a good entry. Okay, well, the funny thing is, so on CNBC, Jim Cramer was selling Walmart. And look, Walmart isn't a great stock to trade because it doesn't move a whole lot. It spends a lot of time at 5. It's a very good place to be when there is turmoil in the marketplace. But here is a great example of a good entry. So we say what you want to do is buy rising demand. So see, this is price. This is Walmart's price over the trailing 30 days. And this thing that doesn't move, that's sentiment. So here we had weaker sentiment. Doesn't matter whether the price goes down right away, but it didn't beat the market. That's the point. But when it rises back to 5 and then it ticks up, if supply, short volume is declining and demand is rising, if you have more demand and less supply, what happens to price? Price rises. That's a classic example of a great entry point. That's what you look for. I want to buy rising demand and falling supply.
So is there a way to scan for this sort of thing? Or gotta just...
Oh yeah. So you can, what you can do is you go in here and you go create a portfolio that says, okay, what do I want? Well, if the market's going to decline, then I probably want large caps because that's where all the money rushes if the market declines. So let's say we want this to equal to maybe even, well, let's just say large caps. Okay, so we're going to add that rule. And then we want to come over here and say what we want is the sentiment trend. So we want to take market structure sentiment trend is equal to up, right? So we want rising, we want an uptrend. We want market structure sentiment that is equal to or greater than 5, let's say, because we want at least that fulcrum. Above 5, more demand. Below 5, less demand. And it's mathematically wild that we screen for stuff that spends more time above 5 tends to do well. So that's what we're going to do. So we want to be greater or equal to 5. All right. So that's pretty good. And I'll tell you another thing I like to do is I like to have liquid stocks because if a stock moves 5% in a day, which is not uncommon, believe it or not, the whole market moves 2% from intraday high to low. Look at Zoom Info today was at 70.87 and 68.50. It's a huge spread. So where you sell can have a huge difference, make a huge difference. So I like to buy liquid stuff. So dollars per trade, this is the amount per trade. And I want to say greater or equal to than $10,000, because that's going to be pretty liquid. All right. So that then we can run this query, and let's call it our Spencer Israel portfolio. And we're going to create that and see what it gives us. It's just going to go look at the national market system and give us all the stuff that meets those criteria. And so that found, we'll go down to the bottom to see how many. It found 38 companies. So that's an awful lot of, that's a lot of stocks. So then we can find which ones are better by, say, sorting them by sentiment and short volume. Like maybe I want the lowest sentiment. But here, for instance, KLA. So KLA, great semiconductor equipment company in 260, 70 ETFs, excellent stock to own. It's in the tech sector, so is that a great place to be? Well, here's another example of where I'd say one thing is good, but not the other thing. So here, demand is increasing, but so is supply. So if supply rises at the same pace as demand, what does price do? Stays about where it is, right? That's not what we're after. And I think money is not going to go to tech. It's, real estate actually has been a great performer, but I would probably, because we can go look at this, I will go find where the money's going. I can look at my dashboard and say, well, is it going to healthcare? Healthcare is a better bet. But here again, I would look at this and say, well, demand is increasing, but so is supply. Supply is well above that trend line. When I run into these things, when I'm hunting around and I can't find good stuff, and I have all kinds of ways to look at the data, it's telling me something. There's nothing wrong with the data. The problem is the market. If everything you test goes, well, that's no good, well, then don't do it, right? Just wait till everything improves and you can make money. I'll tell you, it's not complicated. You just have to do what the data say. That's the hardest part.
That reminds me of the grandpa meme from The Simpsons, or is it Grandpa or Homer? I don't remember who, but it's like, I'm going to butcher, but am I the problem? No, surely it's everybody else that's wrong.
Right. It's a perfect saying. And
Yeah.
I'll throw in a cowboy saying. Sometimes the best way to double your money is to fold it over and put it back in your pocket. There are times for that. I'm only in the market about 30% of the trading days.
Yeah.
Yet I can consistently beat the market handily. And it's because I'm very careful about not doing that. Don't just buy something because people are talking about it. Make sure the supply and demand are correct.
All right. Alex asked us in all capital letters Alex, let me find your question. Alex wanted to look at GM, right? That's what it was. I think it was GM. Yeah. Alex Mendez, check General Motors. Okay, Alex.
Okay, we'll do it. Let's look at GM. And GM used to be a great stock to trade, and it's been. So, here's an example of these are very interesting conditions. So this is just a 30-day period, Alex, but look at this. So demand has not been below 5 until it's about to go there. But this whole time, GM's been a great stock to own. The only challenge is look at how high short volume was right here. So if I owned GM and it got to 10 and short volume was way above trend, I would leave right there. Don't buy falling sentiment because you're buying decreasing demand. Well, what will probably happen, even though there's been massive short covering here? So what this tells me is high frequency traders created stock to fill demand for orders. The GM had reasonable results. And so then they fill that back in because it's just a ledger entry for them. But I look at this data and say, now we want to wait for another entry point. And if we backed up the data, where was the perfect? I like to look at 90 trading days. There's our entry point. I like the tick above 5. So see, short volume's well below trend. It is rising, but it's well below trend. And I would own it all the way until demand began to fall. And then I'd leave. Just makes it very simple. You have to not second guess yourself. Like I'm looking at, I do it. I sold Moderna, made money on it, but I wanted to own it to 350.
That chart looks
and
hard though. That looks hard because you've got 2 false demand breakdowns there.
What do you mean?
Like within that, you 2 periods of falling demand within a larger uptrend.
Well, that's okay as long as it mean reverts to 5. I mean, 5 is the fulcrum.
Right. Okay. So, I hear you.
So, I mean, if you divided this right at August, there are 2 hemispheres. It's spending more time below
Yeah.
5 than above
Okay.
it, and
Yeah, that's
price
fair.
goes down. More
got you.
time above. That's, to me, that's what we call the 5-5 rule. Buy stuff that when it rises above 5 and sell it when it returns there. It's only one thing. That is about, call it 82, 83% statistically significant. Meaning, if you do that about 82 or 83% of the time, it will work. But that also means, 17, 18% of the time it doesn't.
Yeah.
Sometimes you buy ones and sell 10s. I used to trade GM before the reverse stock split. Buy it at 1, sell it at 10. It was a very good strategy. It's changed now that the liquidity has changed.
Okay, a couple more here from the chat.
Okay. Yeah.
We've got Micron. That's where it was.
Okay.
Micron from Cameron Dole, MU.
Yeah. This is an Idaho company. This, I grew up close to Boise, Idaho, and
I did not know that this is an Idaho company.
This is a Boise, Idaho headquartered company started by the guy who founded Ore-Ida Potatoes, which makes the French fries that furnish McDonald's. And he had this little tech interest, and he created this company called Micron, and hired a bunch of
guy
cool
that's
engineers.
had a cool life.
Oh,
I'm gonna get him on the show. But anyway, tell us about the stock.
So immediately in the 30 days, you look at it and say, well, it's no good because it's not spent a single day above 5. So, if we'd have to right now, what would I be doing? So I would wait. I'm certainly not. Here's a great lesson for all traders. If broad market sentiment is way high, and so then it's telling us that the market could fall, and something is still rising toward 5, the likelihood that it gets there diminishes. So immediately, I'm not buying Micron. Okay, right away, I'm not buying Micron. But let's go get a sense of when we might have. Really, it doesn't look good at all in here. For a full quarter, Micron has been lousy. And why would I say that? You say, well, here it's above 5. Yeah, but the whole time if you took the amount of time it's spending above 5 and compared it to the amount of which we can do that very easily. It's not good. I can go over here and profile this. And this will tell me right away how much time Micron is spending in those 90 days above and below 5. Well, look at it. It spent 47 of 90 days below 5 and 21 days at 5. So at or below 5 way outweighs being above 5. Not doing it. Now, this could improve because what tends to happen in the market because of passive investment behavior is that things change every quarter. That's the truth. People are going to be underweight Micron at some point ahead. They're going to have a model that they're supposed to follow. And now Micron is supposed to be 4% of their model, and it's now 2.8% of their model. So when would they reweight? Well, probably in the new month. You get past month end, you got money coming in, you look at your model and you say, okay, I'm going to reweight into Micron. Now, I'd look at it. These are important things to understand. It all comes back to understanding your environment. Your environment is the stock market, and it's important to understand how it works. What does passive money do? Passive money and stock picking are exact opposites. Did you know that? Probably not. You assume that all investors want to.
Yeah, I mean,
right? It's very important. It's an important thing to know because passive money is 3 times larger than active money as a price setter in the marketplace. So,
and who is passive money? Really, what you're referring to is pension funds and large wealth managers.
Correct.
Right?
I think of it as 3 things: exchange traded funds, even if they're Cathie Wood.
Sure, Vanguard. The Vanguards and BlackRocks of the world. Sure. Okay.
There you go. BlackRock, Vanguard, State Street. That's the way to say it. The big 3. They're top 20 shareholders in virtually every single stock in the stock market. So when they move their money from tech to consumer staples or to real estate and energy, which is what they did, that's how energy outperforms every other sector by 16 percentage points this year. It's because all the money went, let's go shift into that. Well, they used to be 2.8% of the market, energy stocks. But wherever that money goes, it's going to have an effect. And they don't pick stocks. They follow a model. They don't want to beat the benchmark. They are the benchmark. The worst thing that can happen, this is what happened with Snap, by the way. So we can measure it. So Snap plunges 25%. Well, active money was not a seller of Snap. Stock pickers were not a seller It's because they skewed from the mean. So then that causes tracking errors for me, and I dump it. But I've probably already offloaded my risk onto Goldman Sachs. But that's important to understand. Micron, wait for it. We could go look and say, well, what's the best entry point for Micron? Let's say, what if we bought it at 1 and sold it at 10? If that opportunity arose, would that be worthwhile? No, not in the past 90 days. But what if we looked at a different time frame? We could. Then you could say, okay, I want to know when it's a 1. You can create an alert for that so that it will tell you when the conditions that you like exist. We're not going to get good data in the 90 days because it's not been a good stock. I can see that, so, but we could figure it out.
Okay. I would be curious if we could apply this, and this will be the last one, apply this way of thinking to a stock that is not super thick, but is wild. Genius Brands. I don't know if you have the data for it.
Genius Brands.
GNUS is the ticker. This is
GNUS.
not a widely held stock. It is volatile. It does do crazy things. Earlier in the year, it got to like, how high to get? $5 earlier in the year. I don't. No, not quite 5, but it got to like $3. It's doing what it does again. It just spikes for absolutely no reason, and everyday trader sees it because it's at the top of every scanner.
Right.
So what do you propose is happening here?
So what's happening is that, and this probably is heavily retail driven.
Yeah.
I
could have told you that.
This is a DWAC. This is a meme stock. That's what it is. So what's happening here, where it jumped from on October 22nd, it was $1.34, and by on the 25th, it closed yesterday at what was 203. Wow. But look at short volume down below. See this down here? This is the supply side of the equation.
Mm-hmm.
See how short volume jumped from 40% to 56%? This is this principle that I've talked about many times. Spencer, you and I have talked about this.
Yeah.
This is the market maker exemption to short locate rules. So if 0% of Genius Brands holders sold stock, it would still go up 80% because Citadel or somebody like that will manufacture stock to fill limit orders, particularly if those are orders for 100 shares or less, because they have to, by law, fill them. That's why I often trade 95 shares of something, right? Rather than, I'm not putting in 200 shares because I know my 95 share order has to be executed at the best price. I'm gonna get the best price because it's the law. So here's what happened. So a bunch of stock was created and there were a bunch of limit orders in the pipeline at higher prices, and wham, they all got filled. Just like that with created stock. And whoever it was, Citadel or Two Sigma or Jane Street or somebody like that, made a half penny or a tenth of a penny all the way up. And then when the limit order pipeline has been filled, the reverse. So that's the danger with these. But even so, the math would have told you, right? You could have said, a steeply ramping demand side, it's risky. Our data, it's much more volatile with prices below about $8. Very difficult to calculate standard deviation. But rising demand, falling supply produces gains. And if you'd have done that, you could have captured these. If you get gains like that, though, take them.
Solar Up is paying attention here. How can any stock? Hey, I'll bring it up on the screen. How can any stock have a short squeeze if the market makers that are exempt, in this case, there are a couple of them, can just manufacture infinite short sales?
Brilliant question. And I
Yes.
do not understand why members of congresspersons don't ask Gary Gensler that very question. You should testify before Congress, my friend, and ask that question, because you're exactly right. There cannot be a true short squeeze. There can be funds that make mistakes, like Melvin Capital. Melvin Capital made mistakes. They were not a very sophisticated hedge fund. Sorry, I don't mean to insult folks at Melvin. Who got destroyed and did get short squeezed. If you haven't hedged your short position, and most sophisticated hedge funds do that, then it's your own fault. But you're exactly right. There are really very few true short squeezes. We see it in the data. Every now and then it happens, but the glaring flaw in the stock market is that there really are no short squeezes. GameStop was not a short squeeze. AMC was not a short squeeze. DWAC, the stock was public for 2 days and it traded 10 times its outstanding shares, and it's because of high-speed trading and the manufacturing of stock. So you now know something that most
That's a great point. It's a great point. Everyone is quick to say, short squeeze. Oh, nope, gamma squeeze. Every time the stock rips up 300%. But
not true. But if you folks, you're using Edge, you're going to know. If short volume takes a steep drop, yes, there's a squeeze. If it goes the opposite direction, which it just did here, stock is being manufactured to lift the price. Yep. And what will follow from that is a cover, and then the next uptick in short volume. Really, that's how you trade these. I trade meme stocks. Never, ever, ever without looking at the data. If the supply-demand equation is in my favor, I'll go trade them. But the moment we see those fluctuations in short volume, I know now that the supply-demand equation in the limit orders has equalized, and it's time to be out. That's what you got to do.
All right, I put the link up. It's scrolling on the bottom of the screen there. MarketStructureEdge.com is where you can find more of this data, this research. Tim joins us on pre-market prep every Monday at 8:35, and joins us on whatever this midday show. Aaron Bree, we got to figure out a new name for this midday show. I don't like Power Hour anymore. Let's change it to something else. Whatever
Easy
the name.
Live.
Easy Live. Okay.
Easy Live is good. I like it.
Let's workshop it. Chat. Let's workshop it with the chat here. But Tim, a pleasure as always, dropping knowledge on us. Thank you, sir.
Always good to see you guys.
And we'll talk to you again next week.
Congrats.
Have a great rest of your Tuesday, Tim.
Behringer Capital and Benzinga. Great combo.
No, Tim will be back with us on Friday, so we don't even have to need to wait until next week.
I don't look that far ahead. I didn't know that.
You know, AB, I think I'm traveling Friday. I'm headed to San Antonio. So we may have to wait till Market Structure Monday, and then I'll see you, Spencer.
Right. Rain check.
Okay, guys.
Rain check on Fridays. Tim, we'll see you Monday. Have fun wherever you're traveling, and thank you again.
Thank you. Good to see you guys. Thank you.
Okay, AB, it's 1:35, give or take. There's a couple of things I want to discuss before we hop off here. One, chat. Actually, no. Before we move on, chat. I was being serious about the workshop thing. If you have ideas of what you think we should call this show, because I think Power Hour is played out, drop your idea in the chat. Seriously, I'm not kidding. We're open to suggestions. Second thing I want to say is it too early for me to run a victory lap in BKKT?
What, you're gonna buy the dip?
No, not buy the dip. I was bearish this when the SPAC converted 2 weeks ago. Yesterday's move was insane. This morning's move was equally insane. You're now down, if you bought this, at the open, you're now down 24% here today. Is it too soon? And if it is, you can say so. Is it too soon for me to take a victory lap here? Because there are a lot of people that chase this thing that are now lost money or underwater. AB, what say you?
What say me is that I do not know what this stock is or what it does.
Okay, that's fair.
I saw the move yesterday that it was up so much. I don't know. I don't know anything about it. I know people were calling it out in Discords and stuff, so I don't know if that was related to the move or what, but I know nothing about this stock. I would say I would not be a buyer here based on the move today. But who knows?
Fair. Wait, I want to get into some things from the chat. Shelly asked, is Neil leaving Benzinga? No, at least not to my knowledge. Neil is not leaving Benzinga, but what Neil is doing is stepping back from his streaming. As much as he likes it, he has many other jobs here as the head of our marketing. And unfortunately, I think he was just taking too much time. The stream was taking up too much time, and he was feeling a little bit burnt out. So we will still have Neil on stream on occasion, but not on a recurring basis anymore. It was just too much for the poor guy, I think. couldn't handle he couldn't handle like his, he's got a real job, like an actual job here, and this was like a side project, and it was just becoming too much. So we will still hear from Neil, especially if you're on our webinars. Neil's making frequent appearances on our webinars, but he's still around. He'll still come on. But what is this?
So I just saw this headline. This was from today at 11:26 a.m. from NPR. Leaders from Snapchat, TikTok, and YouTube are going to have to testify. Actually, I don't know. Are facing lawmaker. I don't know. I don't think they're. Let me see if they're going to have to testify. Either way, it looks like the subcommittee of consumer protection is kind of raising some questions after the Facebook whistleblowers. But what I was going to say is interesting is we've talked about Facebook today, Spencer, how Facebook is trading lower about 5%, but Snapchat's up like 2.5% right now. And this doesn't seem like great news. I don't know. It seems like a lot of times you'll see stories like this and then nothing ends up really happening on like the regulation side. I don't know why that is. But
because it takes forever. Nothing ever. Think of all the bad things you've read about Facebook in the last couple of years. And in terms of regulation, there's been basically zero consequences, right? I mean, the DOJ was coming after them and had their lawsuit dismissed. They have to refile. Or was that
I honestly think some of the lawmakers are like incentivized to not do anything, because if you're, like a Democrat in Congress and you support doing something, then you're seen as like
no. This is a bipartisan issue. Everybody hates Facebook.
No, I know. I'm saying on both sides of the aisle politically, though, I feel like you're incentivized to like not make these drastic changes, whether it's an antitrust or investigating on consumer service. So I saw a thing last night that Facebook employees were upset because they wanted to create in 2020, they wanted to create like a voting information on WhatsApp and put it, because I guess WhatsApp has a very large Latin American population.
Yeah, it's huge.
They wanted to create like in Spanish how you can vote, how you can go to the polls, and Zuckerberg struck it down, saying like he didn't want to seem partisan, which the employees were saying like, what do you mean partisan? Like, we're just showing people how to get to the polls. But in his mind, he's like, making this move would make it look like, oh, big tech, Democrat, all this. So it's kind of savvy on his part to say, even though it's not necessarily partisan, that's how people are going to view it. But Facebook employees were upset about that. So I don't know. It seems like all these big tech companies are getting pressure on both sides of the aisle for some sort of, reckoning, regulation. I don't know.
All right, wait. Can we? That's enough of Facebook for one day. Can we go through some of the chat's ideas for the show? All right, we've got midday show.
That's what it is.
He's going for functionality. He's going for practical. Okay, we got midday with chat. We've got what you said, BZ Live. Aaron, that was your idea. Calm now, Minnow. Easy Trade. Easy Trade is the proper name, apparently. Encow's saying the Power Idea Show. What is it with the word power? Hour of Power? I like this one from Voodoo, actually. The show that took over for the failed Power Hour new name. I like that.
I wouldn't say Power Hour failed.
We're just
we can go through changes.
But I think you all know why you haven't seen Luke and Jason on the stream for the past couple of months. It's because they were working on this deal. And just because the deal closed now doesn't not mean the work is over. The work really has just begun, because now we have new corporate overlords that we have to serve. So
they don't like to be called that, Spencer. They might be watching.
Oh, damn. You're right. We have to be on our best behavior, such as by not calling our new friends corporate overlords. The Benzinga Hour, says K Banat. We got BZ Presents. Market Midday from Obi-Wan. BZ Buzz. Hurt Scrambler. We got some ideas here. Some of these ideas are better than others. It's gains time. Oh, wait. Who was one? Was it Max that suggested we pump iron while we do the show? Power
That could
Lunch
be
isn't Power Lunch the name of a CNBC show? I think it is.
So. I think
I
so.
think that's the name of their CNBC.
I don't think we can do that.
I don't think we can do that. The halftime show. The Wonder Twins. Ooh, AB. What say you about the Wonder Twins? I've heard worse. That's not the worst idea. That's not the worst idea.
George Carlin with some good ideas in the chat.
Here's one. Lunch with Benzinga. I don't hate this one actually. Wait, what if we ate? What if we ate while we did the show? That'd be weird, right?
That'd be terrible. That's a big what is it? Passe in TV.
Passe. Okay. Spencer's Shelly knows where my bread is buttered. Spencer's risk management show. That's funny, Shelly. I like that one. I like that. All right, we got some ideas here. We got some workshopping to do. We got.
What about BZ? Or in the chat, BZ stock talk.
Okay. My issue with BZ is no one knows what BZ is. That's why I'm partial to Benzinga.
The true zingers do.
I know, but everyone else doesn't. Okay, AB, we've reached the time of the show of the show today where we promised some YOLO trades. So,
yeah.
Do I need to open up my Fidelity account or my Webull account?
I've been making trades. So I had some positions and I was red in them, and I've been trying to trade my way out of the red, which hasn't really been working. So I don't know. I mean, tell me in the chat if you got a stock that you're watching at. I was watching Snap, and so Snap. Let's pull up Snap's chart real quick. Let me get my BZ Pro up here.
We got Snap.
No, I want to do it.
You want to do it? All right, fine. He wants to do it.
Whoa. All right, hold on. All right, it's because I want to be able to show like exactly what I saw.
Okay.
So this is
okay. Keep going. Sorry.
What was that?
No, Coupon Boy has a YOLO idea for you, but we'll go after this.
All right. So we saw this big like spike up. Snap was about 5% higher at $57, and it came back down. And right around here, I bought a weekly $57 call because it looked like, oh, we hit support. And a lot of times, like my theory, I don't know, there might be technicals to back this up or not. But if we hit this high and then we have support and we're moving back up, then I feel a pretty high conviction that we're going to be able to get back to this price again, if not surpass it. And at least if we do get back to that price and then we hit, we start going down again, it's kind of like a double top, then I can sell back up here and make some money on those calls. But maybe I bought them like right here. So those snap calls are not working out for me right now. And they expire this Friday. So not a lot of theta to be working with there. I just need good movement on the way up. So I'm hoping for Snap to rip another like % or two higher. That's kind of why I pulled that NPR article up, because I saw that while I was looking up Snap to see if there was any news driving Snap higher or lower today. The other thing I was trading was Disney. I had some open calls on Disney. Let me go to the dailies, which Disney actually was up at one point today and now is down. We can see it took this big hit. I don't know if that was from any news or anything. Let's go to the overview in Benzinga Pro, go to the BZ Wire, see if we have anything on Disney. No, nothing really that would cause Disney to take this big dump in the middle of the day. But I don't know. I mean, like I said, I'm in the red today. I'm looking for a trade to get me out of the red. Let's check the chat. We've got some good-looking, smart people in the chat.
Wait, I have an idea for you, AB.
What's that?
It's a pre-earnings play, but actually it's a pre and poster. You buy it before earnings is the idea, and earnings are Friday. And my idea is Skechers. Can you pull up my chart for a second?
Yeah.
Thank you. SKX. So this green candle from the 21st, that was Croc's amazing report. And if you don't know what I'm talking about, I'll pull up Crocs for a second. Apparently they're just like, they can't make enough shoes.
Well, okay, you're on the daily. Go to the weekly real quick and just zoom all the way out.
Okay, fine.
Just look at how strong Crocs' stock has been.
So like, long term Crocs is a monster, but I want to show you. So, but on the daily, so this gap, right, that huge gap up, that was earnings. That was Crocs earnings. It was great quarter. They can't make enough shoes apparently. So on that headline, on that earnings report, Skechers did go higher, but we've kind of forgotten about it. I mean, not forgotten, but it hasn't moved with the same gusto in the ensuing three or 4 days. If Crocs is any indicator, the shoe market is apparently on fire right now. They report Friday morning. No. Thursday afternoon, I stand correct. Thursday afternoon. Sorry, it says it right there. I can't read. And if we want to use Crocs as your indicator, this may not be a bad YOLO long into earnings.
Yeah, I hear you. What brands does Skechers have under its names? Because the Skechers brand itself doesn't excite me that much.
Yeah, I don't actually know. That's a good question.
Crypto Morning Scores or Crypto Morning Show saying that's sketchy.
What brands?
Is it just?
I think
Skechers?
it's just Skechers, man.
I don't know. I don't really like it. That Crocs has like momentum behind it. Like we went when we were talking about Crocs, not too long ago. It was when Luke was on the show about a month ago. We were talking about Crocs, and we went through all the different like special promotions they have with Crocs. Like they have like Luke Combs shoes, Post Malone shoes, and we were on their website, and they were all sold out. Literally every single. I mean, that should have been our indicator then that they were going to have strong earnings, because all these special shoes that they were putting out, and mind you, they were selling them for like $200 a shoe. You know, so they weren't like cheap Crocs that you just buy at the mall.
All right,
they were all
okay.
sold out.
That's fair. That's fair.
Jay Rice is saying Skechers is big in golf shoes and comfort.
Shouldn't you know that, AB? You're a big golfer.
Yeah, I don't have Skechers golf shoes. I have Nike golf shoes. I love my Nike golf shoes. I actually have a couple different pairs. But yeah, I mean, I don't think the Skechers brand is like that exciting, but maybe you're right. I don't know.
All right. Well, that was my idea.
I don't hate the play. I don't know enough about Skechers company to be like, yeah, I'm also expecting a blowout earnings.
I'm not either. I was just throwing it. Okay, wait. The chat's dropping every ticker that they want to see higher up in the chat.
Igor saying boomers like Skechers now. Hasn't that always been Skechers things? Like they make shoes for like old people.
Wait. Can we go to your chart for a second? And can you look at Ford for Juan? Juan has $16 calls for Ford for mid-November, and he's not feeling confident anymore. No, that I assume those weren't very expensive. Juan, no, you're okay. Why? Because you're down 2 days. You're down 2 days in a row.
No, I don't know. These three red candles are looking a little toppy to me.
Wait. What's that top from June? What is that high in June?
Up here.
Yeah, what is that?
1645 all-time high.
I don't know.
Not all-time high. Sorry, it got up to 1670 in October.
What's the stat? What's the stat? 90% of calls expire worthless. How
many? 90%?
I don't know. I made that up, but something like that. What's your break even? 16 what?
We would have to know how much he bought the contracts for.
I'm asking 1610, 1620. What's your break
so
even?
Juan, here's what I would do is if you can hold on to them for a little bit longer, if you're willing to take on a little bit more risk, if Ford keeps going down, I would wait till you hit this spot right here at about 1565, where we have previous resistance, and then right there the stock will either bounce off of it and your calls will go up in price, or they'll go up in value, or if we break through that, then that's when I would get out. I would say, hey, look, this is looking like it could drop all the way down to around $15 flat to right here. So I would wait till you get to this spot right here and see what happens with the stock, because it could bounce from there.
Wait, serious? Wait, look higher. When do they report? Tomorrow. Oh. No, Ford's not a big mover off earnings. Ford is stodgy. Ford is slow.
I don't know. Like they could announce something though, not in the earnings report itself, but in guidance or something. Say something with EVs that could cause the stock to move one way or the other.
Juan's break even is 1667, so he's like 90. He's like 80 cents away. That
Juan, at this point, you've made it this far. Earnings are this afternoon. Just ride it out, baby.
Might as well ride it through earnings.
Just ride it out, baby. But hey, nothing. Quick note: all content is for informational purposes and not to be used as investment advice. Opinions do not represent those of Benzinga. Hosts and guests may maintain positions in the securities discussed. I do hold Ford stock. I will make that disclosure. I'm a Detroit guy now. Detroit.
opinions do not represent those of Benzinga or our new parents, mom and dad, Barringer Capital. I do not. Full disclosure, I used to own Ford and sold it. So I don't own.
I don't think you need to disclose that.
Well, I just did. So
Hex, he said
either way,
ABC. What I do? What I do? Hex, what I do? Don't leave.
Wait, hey, Aaron. In all seriousness, my laptop is going to die
That's
any
fine.
second.
All
So
right, bye. All right.
no, I'm still able to be here. I'm not running the show from my laptop, obviously, but I'm just letting you all know that my ability to look at charts or anything is about to go away in like 30 seconds. So
Matty Ice, let me know what so if you were watching the show, if you were watching the show last week, we had Simba Stocks on, and he was trading some debit spreads, and he had me do my first debit spread, and now I've been kind of like doing them a lot. Who did you just high five?
Rohan brought me a charger.
Oh, nice.
Thanks, Rohan.
The Simba was trading debit spreads, and he had me do my first one, and I've been doing them recently. But Matty Ice, I wanted to know when do you do a debit spread as opposed to just buying calls or puts? Like, when does it make sense for you? Are you like, I'm bullish, but I'm not bullish enough to buy straight calls, so I'm going to do a debit spread? And if you don't know what a debit spread is, it's essentially where you sell one call. Wait, I might get this wrong because one's a debit spread, one's a credit spread. It's where you sell one call and then you buy one a little bit higher up. And I don't know. I honestly...
okay, AB, I'll be honest with you. My knowledge of spreads, I'm a very visual person, and I'm not great with spreads. So we're going to have a lot of options people on this show. We're going to, we had Chris Capri on yesterday. We're going to have Robert Roy on. He'll be coming back on our show here in a couple of weeks.
No, I think on Friday.
No, Robert. No, he's coming on this week.
He was on the calendar.
We're not. I'm not here to act like I know everything I'm talking about. I don't. But that's why we bring on people that do, right? So, I would say TBD on that. Aaron, let's see if we can have this conversation about spreads with someone.
Well, okay, a couple things on that, Spencer. So, first of all, Matty Ice is saying basically the last part. So I said if you're bullish but not like super bullish enough to buy calls. He's also saying on a big name stock like Tesla or Amazon, which that was what Simba was trading the debit spreads on, was Tesla. So if you went and bought out just a regular call of Tesla, they're super expensive. But if you sell one call right below it,
I could have told you that. No shit.
Yeah.
Or Tesla is expensive, really.
Or Amazon for that matter. But if you sell a call right below it, then you're lowering your cost of that call, but you're still hoping the stock goes up. Crypto Morning Show, low cost way of playing the option. But you also have a limited upside as opposed to an unlimited upside with the calls. But Spencer, what I was going to say is it's helpful to have these experts on that know what they talk about, whether it's Robert Roy, Options Mike, Chris Capri, that all, are way more experienced in options than I am. But I've heard them all explain it before. And it's one of those things that I feel like until you do it and you just start like dabbling in it, then you're going to get it.
Yep. Yeah.
If that makes sense.
You know what? I totally agree. I've never done a spread, which is why maybe we should just do one live on the show.
Yeah, I have a couple open right now and they're not doing well, so I don't.
Okay, yeah, because I've never put on a spread trade, and that's why I feel like I am not in a position to talk about them because I've never done it, and I wouldn't want to sit here and act like I can or I have when I have not done that. So, yeah, everyone in the chat, you guys know about this stuff.
Yeah, I mean they're smarter than us.
It doesn't take a whole lot to be smarter than you.
Wait, hold on. That was mean, Spencer.
Wait, easy, Mike. What are you saying?
That's what I'm saying. I need to get to the bottom of this. Chipotle and Roblox have a deal in the works. What is this?
Check the news feed. Check the Pro. Hold on.
I'm pulling up Benzinga Pro.
CMG.
So wait, hold on. Did you see the headline? I haven't seen it yet, so I want to guess what's going to happen.
Okay, I just saw it, so just guess.
All right, Chipotle is making a burrito making game in Roblox.
Nope, keep going.
All right, Chipotle is offering Chipotle rewards to Roblox users.
It's dumber than that. It's dumber than that.
Okay, Roblox is putting in-person arcade games in Chipotle stores.
Nope.
All
This
right,
is
one more.
dumb.
I got one more.
One more.
Uh,
You're on the right track with the Roblox doing a thing in Chipotle, but just flip it around.
flip it around. So Chipotle is doing something in Roblox, but what
Yeah.
are they doing? They're not creating a.
They're opening a virtual location.
What does that mean?
Like they're opening Chipotle's in the game.
Oh, okay. So you can go in the game to a Chipotle and make a virtual burrito, and your character can eat that virtual burrito.
Here,
Honestly, I don't hate that for Chipotle because you're getting like branding out to these kids
Right,
that
here.
are then going to be.
Here. I'm going. I just went to roblox.com/Chipotle, which is a thing. Let's bring it up on the screen. We see it.
Yeah,
Roblox.com/Chipotle. What do you get? You visit the cashier in Roblox. Wait, no, what? The first 30,000 people will get one per player. Collect please. So you got to play the game, and then you get rewards. Is that it?
I guess so. All right, wait. Jay Rice just threw us out a spread idea in the chat. Let's go ahead and knock it out live. Let me pull up my
Whoa.
Robinhood.
So, okay. Sell the Twitter 6162 call spread for 50 cents.
All right, wait. You're gonna have to walk me through it while I'm doing it. What did he say again?
Do you want to share your screen or no?
I was. Oh, I didn't add it to the
you're
stream
not.
though. Okay.
So Twitter.
Okay.
Again,
it's a social media app.
How do we get to like? Because I'm not on Robinhood.
Right.
How do we
trade
get
Twitter options? All right. So wait.
How do we get to the options chain?
Well, okay. So expire. When do these expire, Jay? Weeklies, monthlies? Let's do November 19th. So we're gonna sell the $61. All right. So I gotta click sell up here.
Yes.
Sell one for $420. Nice. And then I'm going to
Jay, that cannot be why you suggested this.
I'm going to buy one. Oh, wait, no, this is a call credit spread. All right, so I got to flip them around then if we want a debit spread. Jay's like, oh, God, this is probably hurting Jay. Oh, he wants the weeklies. All right, fine, we'll do weeklies. Okay. For what? For this Friday or next? Because when does Twitter report, Spencer?
Tonight.
Okay,
just do this Friday. There's no, there won't be any difference.
I love it. All right. So I screwed it up. So we got to buy the one that's in the money. No, wait, how do I cancel this now?
I don't know how to use Robinhood, man.
All right. Anyway, I'm going to buy this one in the money. Oh, my God. You can't do a spread with 3 contracts. All right. Buy this one. Sell this one. All right. Now we're going to call debit spread.
Okay. So what again, we're buying the $61. We're selling the $62.
I think best case scenario for us, then it stays in between $61 and $62. Or no, we want it to go above $62, but we're selling that call and buying the $61. I don't know. We're just gonna do it. See what happens.
He didn't do anything yet, James. Hold the phone. You didn't actually do anything yet. It's 2:00. Shoot. All right. We have a replay of the roadmap coming up now. It's gonna start any second if it hasn't already started. All right. Let's finish this up real fast.
Submit. We'll get it filled. Hopefully. Yep. New position. Twitter call debit spread filled.
Man. Wait. I looked away. How much did you end up paying for that?
$50. So look, we can see it right here. I've got $61 calls. I've got the sell for 62, the $61 buy. Wait, Robinhood does have a nice little chart on the spread that shows you, I don't know how to get to it now, that shows you like where you're in the money, where you're out of the money when you're in a spread.
It's your there's a term for that. What the profitability table, something like that.
Yeah, sure. I just don't know how to get back to it now.
Yeah.
All right, well, I can redo it. All right, this will be the last thing we do. All right, so what I bought the 61 call and I sold the 62. All right, so this is the chart I was talking about. Whoa.
There you go. Scroll down. Yeah, there we go.
I know, but it won't let me scroll down on that side.
Oh. Nope. Zoom out. Let me get the comment off the screen.
It's only scrolling on this side.
Let me get the comment.
Oh, here we go.
There
All
you
right.
go.
So if Twitter is above 61.48, then I'm in the green. The most I can make is $52. If it's below
$52 when Twitter is at, finish it off.
$62.
Okay.
So that's best case scenario is Twitter gets to at least $62.
Yes.
If it's in the red, if it's 61 or below, then I'm out the $48 that I paid for the contract.
Right.
If it's somewhere in between 62 and 61, then I'll be either slightly in the red or slightly in the green.
All right. We're going to have 3 days to see how this works out.
Oh,
for you.
Jay Rice said you bought the spread. I wanted you to sell it. You did the reverse. You were supposed to sell the 61 and buy the 62.
Oh, man. And on that note, I think we're done for the day.
All right. Well, see, this is what I'm saying. You got to do it to learn. So now I know next time. I don't know.
Man. All right. Next time it'll be on my account. How about that?
Jay, email us at shows@Benzinga, and why don't you just hop on with us next week and we can do it all
That's
together.
also a good idea. All right. We are on a 72.5-hour break for our small cap conference. We're going to end the show today with a trailer for that. We'll be back with you on Friday. Until then, we've got the roadmap coming up, a replay of that right now. I'll be back with you at 3:30 for At the Close with Joel. And hey, that's right, Matty Ice. We're always learning.
See, that's a good mindset. Mistakes aren't mistakes if you learn from them. They're just little fun lessons.
Is that what your teacher told you when you were struggling to read? Okay,
yeah.
Fair enough. Smash that like button, please, and thank you. bzsmallcap.com to learn more about the conference happening tomorrow and the next day. Thanks so much to Tim Quast. Thanks to Lior. Thanks to Evan from recruiter.com. And thanks to all of you in chat. And have a good rest of your day. I'll see you guys in like an hour and a half.
Smash that like button in the face if you have not already.